our economy is on the verge of entering a recession. At least that's according to the Federal Reserve Bank, who in their latest meeting minutes said that the United States will likely enter a, quote, mild recession by the end of 2023. Now, while it's impossible to perfectly time and predict when a recession will hit, what we do know is, number one, that recessions are a part of our economic system. Two, we've seen recessions happen almost every decade for a century now, and the longest period since the Great Depression that we've seen without a recession was after 2008 before the pandemic. And third, we have a lot of red flags in our economy today. A recession happens when our economy slows down, obviously. Our economy slows down when businesses make less money, obviously. And businesses make less money when people spend less money. That's a little bit less obvious, but this is where you have to understand that our economic system runs on spending. The more money you spend, the more money that somebody else makes. If you go to Sweetgreens and you look at the price of the bowl and you say, you know what, I'm not going to buy any Sweetgreens, and then you walk out, Sweetgreens isn't going to make any money. But then if you walk into Sweetgreens and you say, oh man, these bowls are really good. This salad is worth $20, which Sweetgreens is the only salad that's worth $20. You walk in and you give them your $20. Sweetgreens just made more money. Now, this is where you have to understand the more money you spend, the more money that somebody else makes. Our economic system runs on spending, which means if you made $1,000 from your job and you spent $100 and you saved the other $900, that $900 isn't stimulating the economy. But if you go and earn $1,000 and then you spend all $1,000 at wherever, well, now you're really stimulating the economy because now you're working to spend all of your money. But this is where I want to take it one step a little bit further. Can you tell me what is the difference between this $20 bill and this $1 bill right here, besides their buying power? The difference is this $20 bill is money that I worked to earn. I got this money from my checkings account. And this $1 bill is money that my bank lent me. We live in a credit-based system where if I go and I bought something from you, you're not going to know the difference between this $20 bill or this $1 bill. You don't know if I'm buying something with credit or if I'm buying something with money that I worked to earn, because in our economic system, credit works the same as money. So now, if I go to work and I earn $20 and the bank gives me $1, now I have the ability to spend not $20, but $21. And now I have the ability to spend even more money. So now if I work to earn $1,000 and my bank has $1,000, and then the bank loans me an additional $1,000 with the help of a credit card line of credit or some other home equity line of credit, now I have $1,000 from my job and $1,000 in loans from the bank. Now I have the ability to go out and spend $2,000. Now, for the economic system, that's great news, because that means I have the ability to spend twice as much money today. I have the ability to go to Sweetgreens and buy twice as many salad bowls, buy twice as many avocados, and buy twice as many Gucci belts, because I have the ability to go out and spend more money today. But this can also cause more severe slowdowns in spending, because remember, slow spending causes a slowdown in business profits. A slowdown in business profits causes a slowdown in the economy, and a slowdown in the economy can cause a recession. You'll see how this all ties together. Because now if I go out and I keep spending money on debt, what does that mean? Well, if I'm spending money on debt, that means I'm spending next month's earnings and next year's earnings today. That's what debt is. Debt is you spending your future income today plus interest. So now if I go out and I keep spending more and more money with the help of lines of credit, with the help of credit cards, eventually I'm going to hit a point where I'm going to be over levered as a person, because I kept spending and spending and spending, and now the bank says, no more spending for you. No more credit card debt for you. You got to start paying this off. Now when I hit that breaking point where I have too much debt, I can't keep spending. And now I have to use my money not to go out to Sweetgreens, not to go out to Gucci, but I have to use my money to pay down my credit card debt, and I got to pay down my high equity lines of credit. Now, because I have so much debt, I have to use my income more to pay down my debt because I've hit that breaking point. When that happens, now businesses suffer because I've spent so much money in the past number of years. I've built up this huge debt pile, and now I got to start paying it down. And now I'm using my money that I'm working to earn not to spend and stimulate the economy, but to pay down the debt. Now, when you go through this phase in the economy, which is after the point where people are over-levered, Now people are working to pay down their debt as opposed to spending and stimulating the economy. So now when people are working to pay down their debt, that means businesses aren't making money, or at least not as much as before, because more and more people have to now pay down their debt. So that's why when you see these debt bubbles happen and people get over-levered, eventually you hit a breaking point where the credit stops flowing. Banks stop issuing more money because people have too much debt, and now they need to be paid back. And now when people are paying the banks back, now people aren't spending. When people aren't spending, that means businesses aren't making as much money. When businesses stop making as much profits, that means they don't have money to invest in new stores. They don't have money to hire more employees. They don't have money to invest in research and development, which then causes the economy to slow down. When you see the economy to slow down, well, that's what a recession is. When you see a economic slowdown, especially over a period of at least 6 months, that's what causes a recession. So an economic slowdown is what causes a recession, but an economic slowdown is caused by a slowdown in business profits, and a slowdown in business profits is caused by a slowdown in spending, and a slowdown in spending is caused when people get over-levered because people have already spent too much. So after you hit that breaking point, that's when you start to see that recession, which is very interesting because that means that you generally see a recession happen after a big economic boom. And that's exactly what happens. If you think back to our most previous recessions, besides the 2020 pandemic, because that might be a little bit of an exception, even though we were kind of in a booming economy before the pandemic, but that was kind of like a forced recession because the economy was shut down. But before the 2008 recession, well, we were in a boom economic period before the economy crashed because everybody was buying a home. People were living large. Everybody saw their wealths rise because if you bought a home, you saw this astronomical rise in wealth because people saw the property values grow, so people were buying things, and businesses and banks are making money hand over fist until you saw this over-levered period come, and then it all came crashing down. Same thing before the 2000 dot-com bubble bursting. What happened then was we saw this huge rise of internet companies right before the year 2000. And people who were investing in these companies were making so much money hand over fist, and people were living large. They saw how much money they were making so quickly. People were able to spend big, live large. And then came the year 2000 when the party came to an end because the credit stopped flowing. And that was when the bubble burst. And you saw a lot of people lose money very quickly. So you see this economic boom period followed by too much spending, followed by too much debt, which then leads to, well, a recession period, which is now where you have to kind of pay down that debt and reset from all the spending that you did. And now if we look at where we are right now, we are seeing credit card debt rising. We're seeing household debt rising. We're seeing corporate debt at the highest levels pretty much ever. And this is a period now where also interest rates are rising, meaning the cost of servicing this debt is also rising. And every time we've seen a recession over the last century, over the last 100 years, we've seen the exact same three things happen. Number one, people lose a lot of money when you see a recession or a market crash. Number two, you see some people make an insane amount of wealth when you see a recession or a market crash. And number three, you see the government come in and try to remedy the recession and market crash and try to create programs to prevent market crashes. And most of the time, these programs end up creating a bigger divide between the rich and the poor. And this is where now I want you to understand this, not be shocked by this, not be blindsided by this, but rather be able to find the opportunities, because the reality is, number one, recessions happen. Period. They have happened and they will continue to happen. They happen almost every decade or so. And so now when you understand that, you can understand that you don't need to be so shocked when you see economic pain happen. It is a part of our economic system. But instead of being shocked like the majority of people, I want you to be prepared and find the opportunity. Because while most people end up losing money, getting hurt, getting panicked, and getting freaked out when you see a recession, some people see the opportunity. Now, where is this opportunity? Generally, where the big bubble was. When the 2020 pandemic hit and you saw the recession hit very briefly, we saw the price of pretty much everything, stocks, cryptocurrency, not really real estate, but stocks and cryptocurrency, a lot of paper assets fell very quickly. The investors that came in and bought were able to make a lot of money very quickly because, well, the Federal Reserve Bank opened up the money printer after the 2020 pandemic, and then prices skyrocketed. When the 2008 crash happened, well, first it was the real estate market that really got hit, and that was the big bubble. People that bought real estate after the 2008 crash were able to buy real estate for pennies on the dollar. Literally. Like when I started investing in real estate after the 2008 crash, I was buying properties for pennies on the dollar. The first property that I bought, I happened to be in the Metro Detroit area, which was arguably the hardest hit area after the 2008 crash. And the first property that I bought was a condo that originally sold for $150,000. It was a 1,000 square foot condo, 1 bedroom, 1 bath, and it got foreclosed on, and nobody was buying it, and the banks needed to liquidate it, and I came in and I bought that condo for $8,000. That wasn't my down payment. That was the total price of the condo. So literally pennies on the dollar because of how big the bubble was and how much the bubble burst. You also saw the stock market get cut in half during the 2008 crash. If you bought good companies after the 2008 crash, you were able to make a lot of money. After the 2000 dot-com bubble burst, you were able to buy internet companies and a lot of stocks, again, for pennies on the dollar. We saw the Amazon company, Amazon that we know today, Amazon, that stock fell by over 90% during the dot-com bubble burst, meaning you could come in and buy Amazon for pennies on the dollar, and the people that did were able to make a lot of money. Now, of course, it's risky because people are losing the money. There's a lot of panic. There's a lot of fear. There's a lot of greed. There's a lot of confusion. There's a lot of excitement. And this is where now you need to be able to prepare. That means using your money smartly today. That way you have a financial cushion in case something bad were to happen. You have money to fall back on. And second, you have money to take advantage of opportunities. Meaning you have what people like to call dry powder. This is what people on Wall Street like to call money for investing when things go wrong. That when things go wrong, you have cash, money to be able to capitalize on opportunities, because if you see a good opportunity to invest but you have no money, you can't go out and actually invest. And this is where now preparing when times are okay, that way you can take advantage of times when they're not so okay. It's so important that way you can actually capitalize on the opportunities. Now, where will these opportunities be? Well, a lot of people have been labeling what we're seeing right now an everything bubble because of the amount of money that was printed during the pandemic era, plus post the 2008 recession era. Because of all the money that was printed, we saw the valuations of pretty much everything rise. So we could see opportunities in real estate, in stocks, potentially cryptocurrency, whatever assets that you're looking to buy. There could be opportunities there. And this is where now you need to be, one, financially educated, but then second, you also need to be prepared. That way you can capitalize on opportunities that might come your way. We've already begun to see some of the issues in the banking sector after the Silicon Valley Bank collapse, because then people started to really panic, move their money away from banks. It created some opportunities for investors who did go out and start investing in some bank stocks that they felt were good companies that were hit hard. Again, I'm not telling you what to invest in. I'm just showing you examples of opportunities where we're already seeing pain and concerns in the banking sector. That's one area where people will be able to find opportunities. Some people will lose money there. Some people will find opportunities there. Second, we're seeing a lot of concerns in the commercial real estate market, because a lot of commercial real estate debt is not a 30-year fixed rate mortgage. They are adjustable rate mortgages that will adjust every 5 years or so. And about half of the total commercial real estate debt out there is set to readjust in the next 24 months. And we have a lot of empty office spaces where landlords are struggling to make their payments. And interest rates are so much higher today than they were 2 or 3 years ago. And so when these landlords go to readjust on their commercial offices or commercial buildings that are sitting vacant, and if the bank readjusts their debt twice as high as it was before and their monthly payments double, well, that's going to put a lot of pain and a lot of pressure on landlords who, one, will not be able to qualify for a refinance, and two, who won't be able to continue making the payments because they won't be able to afford all these losses. So that's going to create pain and opportunities in the commercial real estate sector as long as interest rates keep rising. And third, same with the corporate debt sector. Over the last number of years, we've seen the amount of corporate debt out there balloon because corporations went out and borrowed insane amounts of money. And what did they use this money for? Well, some of these corporations use their money to invest into the company, invest in more stores, invest in more research, invest in their products. Some corporations use this money to do something called levered corporate buybacks, meaning you can go out, borrow tons of money and use this money not to go out and buy an income-producing asset, but rather use this money to inflate your stock price. It's good in the short term because it makes the shareholders richer, because if you own a stock and a company does a stock buyback, the stock price goes up. But it can hurt in the long term because that means the corporation has to spend their future earnings to pay back this debt. And it wasn't a big deal when interest rates were at their lowest levels ever in 2020 and 2021. But as interest rates start to go up and the cost of servicing this debt goes up, because again, corporations don't have 30-year fixed rate mortgages, the interest rates readjust. That means that your payments on these debts go up. And we saw a big example of this with Bed Bath & Beyond. Bed Bath & Beyond filed for bankruptcy recently. Why did they have to file for bankruptcy? Well, Bed Bath & Beyond was obviously having struggles with the internet. They were not selling enough on the internet. People weren't buying the Bed Bath & Beyond stuff. But if you look at the financial side of Bed Bath & Beyond, well, they also had their own struggles financially, because in 2021, they had originally issued a $325 million stock buyback. But then the shareholders and the board got together and said, you know what, that's not enough of a stock buyback. We want to see an even bigger rise in our stock price right now. So then they extended the amount of their stock buyback to $625 million. They didn't have all this cash. They had to go into debt. When Bed Bath & Beyond had a lot of debt that they took on. And now they took out the $625 million. And then instead of using that to invest in their e-commerce store, instead of using that money to invest in their employees, to invest in their marketing, they used that $625 million to buy back their own stock, which made their stock price benefit in the short term, help the shareholders in the short term. But now they didn't have the money to continue making their operations. They were bleeding cash, and they had their obligations to pay back their debts. And now, because they had spent that $625 million on stock buybacks, they didn't have money left over to invest back into the company, and they had to declare bankruptcy. So stock buybacks have their own place, but they can be very expensive if you don't manage your money correctly. And this is where now understanding the financials of what's going on is so important, and where interest rates become so important, because the Federal Reserve Bank is going to be working to bring down inflation. And the question is now, are they done raising interest rates, or will they continue to raise interest rates? And we have a lot of different opinions on this.
Our last inflation report came in cooler than expected, which naturally has some people excited, claiming the win on the inflation fight, which then poses the next natural question. If inflation is falling, does that still mean that we're going to see a recession? And what's interesting is just a few days after the inflation report came out,